Hey, good morning, everybody. For those of you that don't know me, my name is Jay Cattleman. I'm the Community Development Leader here at the Jewish Federation of Omaha. We're so excited to have Spencer Levy today to talk to us. He's the Global Chief Client Officer and Senior Economic Advisor for CBRE. And we're very thankful that he agreed to join us today for our kickoff back into our Jewish business leaders. Alex will give you some more information on Spencer in just a few moments. Just as a reminder to everybody, we'll be hosting our very first in-person JBL event for 2021 on the Steinberg Cooper Feldman campus at the JCC on August 13th from 7:30 to 9:30 a.m. At the beautiful and newly renovated campus and in our Shirley and Leonard Goldstein community engagement venue. Our featured speaker that week or that day will be Jason Itkin, who is a native Omaha and now lives in Houston. He's one of the most prominent trial and personal injury lawyers in the country and one of only 4 lawyers in the country who has won a $1 billion verdict for a single client. And he and his wife also own a vineyard in California. We look forward to hosting him and seeing everybody in person once again on August 13th. You can register for that event on jewishomaha.org. Also, feel free to reach out to me for tours of our new campus in the meantime. And if you would like to sponsor a future JBL event, I'll now turn it over to Alex and we'll get started.
Well, welcome everyone. I'm Alex Epstein, founder of Jewish Business Leaders and Executive Vice President at Omni Partners. And we're really blessed to have Spencer Levy with us today. He's one of the best economists I've ever heard, and been featured on CNBC, CNN, Bloomberg, Fox Business, and I'll let him tell everyone more about himself. But before I do that, I do want to thank CBRE for making this possible for the Omaha community. It's very special to have this insight to what's going on globally, nationally, and even some locally here today, and also Bennett Ginsberg, who's the managing director and president at CBRE Nebraska, for making the intro to Spencer. It means a lot to the Jewish community and business community for doing that and letting Spencer join us again. He was with our community last year with the CRE Summit, and it was a lot of fun. And then again, to our sponsors, CBRE and Bridges Trust. Thank you, Bridges, for being our platinum sponsor for the year. This is our first event post-pandemic, virtually, and then our in-person this next month. So really excited about that. We will dedicate the last 5, 10, or even longer minutes to Q&A. So feel free to submit questions as we go, and I'll go through them at the end. But I'll hand it off to Spencer. Spencer, thanks again for joining us, and really appreciate it.
Well, thanks, Alex. And next time in Omaha, because I will tell you that the first gig I lost because of COVID was in Omaha. I was supposed to be there in March for some big gig with your real estate folks, but well, just invite me back. I'll be there in person. So what are we going to talk about today? We're going to talk about the macro, the micro, and the secular. What's going on out there economically, and then because I'm a real estate guy, we'll be focusing on the real estate industry. But these issues that we're going to talk about really cover the gamut of a lot of industries as well. So big picture, the economy is in very good shape, though I do have to differ with my good friend here, Alex Epstein, who said this is our first post-pandemic event. We're not quite post-pandemic yet, but we're getting closer to it. And that is really the best piece of news we can give. But I will tell you that the volatility that you saw in the stock market last week, in the bond market, is related to the fact that we are not quite post-pandemic, and there still is that risk factor out there related to the Delta variant or other things that are going to slow growth globally, perhaps longer than we had thought, but not here in the United States, because I do agree with Alex that we are largely post-pandemic here, albeit we will see continued restrictions on wearing masks, restrictions on international travel, but it all boils down to this. It boils down to 2021 having accelerated growth in the US, and that accelerated growth is going to continue into 22. If you want to throw some numbers on it, we're looking at close to 7% this year, close to 4.5% to 5% in 2022. That's the good news in terms of the macro. Here's the bad news. I already mentioned the risk factors, what could derail us. Here's the worst news. Come 2023, it's going to be same as it ever was, to quote the Talking Heads song for those of you who know the band, because we are going to revert back to our slower historic growth rate, which is going to be sub 2%, which is a bummer, to use a very fancy economic term for you. It's a bummer because I and everybody else wants to grow faster than that. We have to grow faster than that if we are going to do the things that we really want to do. And what are the things that we really want to do? We want wage growth. We want productivity growth. We want a lot of things, but unfortunately, we're reverting to that in 2023. So even though the next 18 months may be partying like it's 1999, that's a Prince song for those of you who don't know the song. It's going to be the same as it ever was starting in 2023. And so for people that run businesses, you need to look at your businesses through that prism. You need to look at through the prism of, okay, how do I best position myself for what's going to be a slower growth future with a rapid growth present? Now, I think the good news is this, is that even though we are seeing this rapid growth today, and we saw inflation rise very rapidly earlier this year, we've already seen it come down in things like raw materials for steel and for wood. The most important indicator for inflation is the 10-year Treasury, and then there are some futures you can look at. And the 10-year Treasury, and I haven't looked at it in the last 10 minutes, but it was around 1.25% today. And that is way down from where it was when inflation was really hitting us earlier this year. It actually breached 1.8% for a moment there. But we still believe that by the end of this year, inflation will be around, or rather the 10-year Treasury will be around that 1.8% level. Next year, around 2.2%. And then it will flatline there, much like the economy is going to flatline in that sub 2% growth rate, which again is not good, notwithstanding all the stimulus we're pouring into the economy today, notwithstanding the fact we might have an infrastructure package of $1 trillion or more. We just aren't growing fast enough. And why is that? Because the bottom line is there are several macro factors that counterbalance the increase in the money supply. So for all of you Milton Friedman fans out here, this is what I call an earmuffs moment. You're not going to want to hear this, because Milton Friedman would say that the money supply is the only thing that matters. And because we had this massive increase in the money supply in the last couple of years, because of COVID, the trillions of dollars that have been pumped in, we should see massive inflation. But what Uncle Milty didn't understand or didn't expect was that we had these counter forces. And the counter forces are, number one, an aging demographic. And we also have what's known as a birth dearth, meaning that we're not getting enough babies being born. We also don't have enough immigration, and that puts downward pressure on inflation, as does too much cheap money, does too much cheap energy, as does innovation itself is deflationary. And so because of that, we do not expect to see inflation, notwithstanding the fact that Milton Friedman is now rolling in his grave as I say this. But the other reason why that Milton Friedman did not anticipate is that central banks around the world have largely abandoned, not totally, but largely abandoned laissez-faire capitalism. You take a look at what happened here in the US, in Europe, and elsewhere, they realized that letting the economy crash was not a good thing. And they decided not to allow that to happen. So there used to be something known as the Greenspan put, when Alan Greenspan was the head of the Fed back in the 80s and 90s. That now is permanent. And so you're going to see this economy where you no longer have the massive cycles that you had before. It's going to be much more measured because the central banks are controlling it, which sounds good. But the reality is you need some bad companies to go away. Because if bad companies don't go away, it's inefficient and it doesn't help the economy over the long term. So the upside is we'll be in a more placid environment. The downside is we may not grow as efficiently, and we certainly aren't going to grow productivity at the levels that we certainly need in order to move forward. So let's turn now to commercial real estate for a moment. And so commercial real estate, remarkably resilient. We, with the exception of the second quarter of last year, which was horrific, we have done remarkably well from both a capital market standpoint and from a fundamental standpoint. Capital markets meaning sales, fundamental meaning leasing. And the areas that are doing best are the areas that you know, which includes industrial and multifamily, and what we would call so-called new economy sectors. And what is a new economy sector? Data centers, life sciences, certain forms of digital infrastructure. Those are doing exceptionally well and seeing cap rates there at record low levels, and very hard to get into those spaces. Why? Because they're really, really small. How small are they? Well, life sciences represents a grand total of 140 million square feet in the United States. New York City, for those people who are counting, is about 450 million square feet by itself. So it's less than Lower Manhattan all by itself. So because we have all this money going into this small space, we have cap rates going down. And we are even seeing in those areas of commercial real estate that have been most challenged, hotels. Okay, what was more challenged than hotels? Nothing. Hotels are now trading largely at pre-COVID levels, but up. Now, there are so many closed hotels in markets like New York, Chicago, Boston, LA, high density CBD markets, but those that are drive-to staycation hotels are killing it. They are absolutely off the charts in terms of demand, and they have pricing power. I just went away with my wife the other day to a place called New Hope, Pennsylvania, which I can tell you is not the biggest city in the world. I had to pay over $500 a night for an okay hotel just to stay there during the week. And the bottom line is that's a good sign for the economy, giving some of these smaller towns, smaller hotels some pricing power coming back. But the reason why we are seeing record low cap rates across the board is because there's simply too much money chasing too small space. So even though in the office sector where we are seeing record pricing happening, it's actually for a very small subset of office. It is office that is either single tenant net leased to a credit tenant, or otherwise a tech office in a tech market like a Raleigh, like a Seattle, like a San Francisco. But even in those instances, if they're multi-tenanted, you need what's known as a long-term WALT, weighted average lease term, for people to get interested in the space. But some of these other spaces right now, industrial, for those people on this call or in the industrial sector, congratulations, you are now the coolest people at the dance, because I will tell you that I have never seen cap rates like we're seeing right now in industrial. Not only are they sub 4 for the best markets, we're seeing some that are sub 3, which is remarkable. And I just got off the phone with a large international investor just prior to this call. And they're like, well, cap rates have to go up because interest rates are going up because there's too much supply. I said, well, don't hold your breath, because the cap rates are really beginning to equalize with what the cap rates have been in Europe for many, many years. Why? Why was there a cap rate difference between the US and Europe? Inflation. The inflationary expectations, while they are still slightly higher in the US than they are in Europe, are equalizing there as well. And that is causing cap rates to equalize. That plus the US is a place of a safe haven is why you're going to see cap rates continue to stay low. And by the way, I say this point blank, and I said this to the investor 10 minutes ago. I said, not only do I expect inflation to stay lower for longer, I expect it to stay lower forever. And I believe that because that's what's happening now in Europe. It's what's happening now in Japan. And because of the birth dearth in particular, and because of limitations on immigration, it's going to happen to us too. We are in for a slow growth future, absent something that I cannot foresee on the horizon. Even a massive infrastructure bill isn't going to do the trick, which is unfortunate, but that's kind of where I see it, and happy to debate that with everybody. So let's talk about a few mega trends now that are impacting our outlook on the various real estate sectors and how it impacts markets like Omaha. Well, let's start with the Omaha question. And the Omaha question is, are smaller cities like Omaha, like Des Moines, going to flourish in a post-COVID world? Are they going to flourish more than they've already flourished? Okay, I'm not throwing you guys under the bus. And the answer is maybe. All right, if you want a definitive answer, I'm not going to give you one, because there are many signs that point in both directions. The signs that point in Omaha's direction are the fact that people can now work from home. And I'm working from home right now. And Omaha has a very friendly business environment, has a lower cost of living. has all these great things to look for it. It's also a very centrally located city, so it's very easy to do business from Omaha around the country. So it's got all these things going for it. So will the post-COVID world be brighter for Omaha than it was before? For those factors, yes, you will see some people moving there, doing some form of this type of telecommuting, to use an old-fashioned term for what they used before Zoom. But what you aren't going to see, and this is where we're going to get into a little bit of a discussion, is the highest quality talent is still disproportionately going to flow to the major markets like New York, like San Francisco, like Chicago, like Boston. And how do I know that? Because we did a study on this. And yes, we saw a net outflow of people from places like San Francisco and LA and New York to places like Omaha, like Denver, like Austin, Texas, everybody's darling. But what we didn't see is these people that are the most highly educated are still going to disproportionately flock to these major markets. And even though Omaha is lower cost, friendly business environment, and does have a very good talent base, it's still going to have to compete hard with these major metro areas, because in addition to the fact that you're seeing a lot of people moving there that are highly educated, they have a lot of people there. The MSA of New York has about 30 million people in it. Austin, Texas, about 2. If you're a big company, you're going to go there not just to get the new talent coming in, but also for what's known as, and here comes a truly complicated economics term, the agglomeration effect. And what is the agglomeration effect? Well, the agglomeration effect is the combination of people, infrastructure, capital, the arts, restaurants, why people want to live in these big cities. And you get something what's known as serendipity, the random encounter with people that causes a positive outcome, which is much harder to replicate in smaller cities. So again, not throwing Omaha under the bus. I'm just saying that you are going to have a net benefit because of some of these mega trends of people being able to work in secondary cities, but you're still going to have to compete hard against these big cities. So what is the punchline? The punchline is don't compete based on cost, compete based on quality. Make sure you attract the most high quality companies, the most high quality talent to Omaha, and that's how you win the long game against the New Yorks and the San Franciscos of the world. Now, speaking of the world, which last time I checked is a big place, what are some of the other mega trends you should be thinking about as you're thinking about the US and the global economy moving forward? Well, one of them is globalization itself. What failed during the crisis? Globalization. And what's failing at the moment? Globalization. And why is it failing? Because if you had, well, I guess really strong binoculars in Omaha to look out at the Los Angeles ports, the ports in Charleston, the ports in New Jersey, you could look and see boats out for hundreds of miles. And what are they doing out there? You know what they're doing out there? They're waiting to get into port because they don't have enough people to pull the stuff off the boats. So a lot of the inflation that you saw in the short term, and you're still continuing to see in the short term, is because of a supply chain issue, not because of the Milton Friedman money supply issue. And that's why we believe that that will be worked out. And you know who's voting with that? As I said, the 10-year Treasury is down about 1.25%. If you don't believe me, believe that, because that is the single best indicator of where the economy is going than any other. That is the number one that I look at just about every day. So what are we likely to see because globalization failed us during the COVID-19 crisis? You are likely to see a +1 strategy. +1 strategy really means China +1, because China has become the world's manufacturing base, and that +1 will be to some other places in Southeast Asia like Vietnam. But yes, you will see more manufacturing come back to the Americas. I didn't say United States of America, I said the Americas, because you will still be competing hard against Mexico, where the average laborer makes 10% of what they make here. But you will also be competing against Canada, because remember when I talked about the immigration issue before? Well, Canada allows a lot more immigration on a percentage basis, particularly skilled immigration, than the United States. And so because of it, they will be a tough competitor, particularly in some of the high tech areas. As a matter of fact, here comes my first of what will be several shameless plugs. CBRE just came out with its tech talent reports. Which cities scored extremely well? The cities in Canada, because of all of the skilled immigration that's coming there that may not be coming here. Now, Will we see more manufacturing here? Yes, you will. And why? Well, one, because supply chains failed us during COVID. People want to be more resilient, including the manufacturing of things like pharmaceuticals. But there's another reason, because another mega trend you need to be keenly aware of is ESG plus R. A lot of letters there. Environmental, social, governance plus resilience. You guys all know what this term means. It also goes by different terms: CSR, corporate social responsibility, DEI, diversity, equity, and inclusion. But let me just tell you what it means from a practical business perspective at the moment. So I'm going to start off with a horror story. We recently tried to sell an office building in London that was triple net leased to a long-term credit tenant. And for those of you who are not in the real estate business, that's about the easiest deal to sell imaginable. You know how many bids we got on that building? Drum roll, please. 0. Why? Because the tenant was a cigarette company. What does that one example show? It shows what we showed on, yes, here comes my second shameless plug, on the podcast that I host for CBRE called The Weekly Take. We had several podcasts on ESG in the last several weeks, which hosted CEOs from companies like Invesco, Bentall Green Oak, CBRE, GI, et cetera. It shows that ESG is now becoming much more important in the real estate sector. And why? Well, to quote Sonny Kalsi, who is the CEO of Bentall Green Oak, it's because Mother Nature's been angry at us. Look what happened in Texas. Look at the forest fires in California and Australia, droughts in Iraq. These things are happening more frequently. And so that's number one reason. Number two, ESG isn't just environmental. It's also social. And the bottom line is the events of last summer, led by the George Floyd tragedy, changed the way the corporate world looks at the S. So much so that that same Sonny Kalsi from Bentall Green Oak said that 2/3 of all of his hires going forward are going to be women and minority. He's putting out saying this is what we're going to do. And that's how most people are handling the S part of the ESG. What they're not doing, and by the way, this disappoints me, but nevertheless, I'm just going to give it to you straight. What they're not doing is building real estate in areas that need more real estate. If you drive around big cities in America, including Baltimore, where I live, there are these areas that we call food wastelands. There are no supermarkets for miles. And I ask some of my investors, I'm like, well, why don't you just build a supermarket there where they don't have one? And this is the bottom line, folks. It's because they can't get the same return on investment or objectively underwrite the same return on investment on that supermarket as they can if they put the supermarket in a demographic area a few blocks down the street that is more well established. So the S is being covered by hiring practices. It's not being covered at this point by people moving that supermarket to the area that needs it. And by the way, I will tell you point blank, this breaks my heart because I live in Baltimore and we lived through a terrible tragedy of the Freddie Gray events in 2015. And when that happened, I spoke to many developers who were in some developing parts of our town, and tragically, they left. And I begged them to stay, but they left because they said they couldn't make the math work or other things like that. So we have a long way to go on the S, but at least we're starting on the S with respect to hiring practices. We're not going there with respect to moving that supermarket to that neighborhood. Now, there is a thing out there that's called impact funds, and an impact fund will target areas like that or target certain types of real estate like affordable housing. But those are the exception, not the rule. The rule now is that people are going to more of a measurement approach of their ESG rather than a point in time approach. What does that mean? Many of you, and I'm sure many of the buildings in Omaha, are LEED or Energy Star certified. Great. That is not the industry standard anymore. The industry standard now is moving more along the lines of the UN Principles for Responsible Investing or the Paris Climate Accords. I got a bid the other day, last week, from an investor asking me about a retail deal, retail, not office. And he said, does this comply with the Paris Accords on climate? First time I heard it. And then I heard it again last week on an industrial deal. Why do I mention this? Because for the most part, when people were talking ESG compliance pre-COVID, they were talking about office buildings. It's now spreading to all forms of real estate, not just because real estate emits 40% of all types of carbon emissions in the world, but also because investors are demanding it. What changed? Pre-COVID, it was occupiers demanding it, and sometimes it was regulatory driven. Now it's investors driving the bus. And many of these investors are coming from Europe. And what am I telling my investors? And I just wrote a viewpoint on this today, which I'm publishing next week. So yes, another shameless plug. But my viewpoint is this: ESG compliance is as much defense as it is offense. And that's why I'm recommending to all of my clients that at a minimum, you better hire a consultant and see what it's going to cost for your buildings to comply. And in many cases, pay the cost, because by the time you want to sell the building, you're going to need to pay it then, or it's going to be a reduction in your purchase price. But bump. It's becoming like your roof quality. It's becoming like in other engineering things. And I remember this as clear as yesterday. Many, many years ago, I was a young associate in a New York City law firm in the early 1990s. And what happened? They passed the ADA in the early 1990s. And when they passed the ADA in the early 1990s, what happened? Every hotel owner friend of mine got really nervous that they were about to go out of business. And they were about to go out of business because they had to change every doorknob. They had to put those little devices that can allow you to get into pools. And so that is what we're facing right now on ESG, not only from a tenant demand standpoint, we're facing it from a capital market standpoint as well. So that is the second major trend. One is the reversal of globalization. The second is this ESG thing is becoming a table stake for people that want to go into business. Third mega trend, demographics. We just talked about that a moment ago, about the movement of people, but there's a portion of demographics movement that I don't agree with. Okay, so there's one form of demographics when you talk about the movement of people from New York to Omaha, Nebraska. There's another form where people are moving from downtown Omaha to the suburbs. You know who's doing that move? Mostly people who would have moved anyways because they have kids, want to put them in good school districts. That's why most people move. I don't think that move is durable from a work standpoint. It is durable from a live standpoint, but not a work standpoint, because the CBDs, because of that fancy word, the agglomeration effect, are still going to attract the most people. Are you going to still see single family homes doing incredibly well for the next year or so? You bet. But after that, you're going to see it flatline and revert. Now, I'm contractually not allowed to use the B word, otherwise known as bubble word, but there are definitely some bubblets forming in single family housing around the country because it's not a durable trend, because most people are still going to work in an office in the city. How do I know this? Am I self-serving because I work for CBRE, this enormous real estate company? No. Well, maybe you can believe that, but I will tell you it's based upon research that we've been doing for 100 years. Now, I went to the Cornell School of Industrial and Labor Relations. And why is that relevant to today's conversation? Number one, if we ever played University of Nebraska in football, it'd be a bad day at the office. But the reason is that I studied labor. And what we're dealing with here is a classic labor issue. And who has the power between management and labor? Why are you seeing so many employees stand up and say, I'm working from home or I'm working hybrid? The reason why is because labor and management power shifted during COVID. How did it shift? It shifted, number one, I think for a good reason. Employers were legitimately concerned about the safety of their employees, but also because when I was studying labor 30 years ago, it always had two assumptions: that labor had perfect information and perfect mobility, and both of them were false. But now, because of social media and other communication devices, and because of technology that literally gives you perfect mobility, labor has a lot more power. And that's why in the short term, you're seeing the pendulum shift to more people working from home or in a hybrid environment. Over the long term, however, I don't see that lasting. Why? Because, to quote my other alma mater, Harvard, great companies focus on productivity. They do not focus on efficiency. And people simply cannot be productive from home. Now, I know I'm going to get rotten tomatoes thrown at me for that comment, but people can't be productive or as productive at home as they can be in the office. You say, oh, no, I can get all this work done. Yeah, you can get work done efficiently. But productivity is a different word. It is not producing more widgets. It is producing more creative stuff. And it also has to do with learning certain soft skills like communication, like networking, like being in the face of your boss. Now, that brings up a whole other issue because that's a DE&I issue. Are you going to treat the people at home better or worse than the people in the office? Well, since the beginning of time, the people in the office were treated better than the people at home. Now people need to deal with that issue. Can they shift the culture to make people treated equally? I don't believe they can. And there's a word out there called presenteeism. I can't even spell it, but deals with treating people differently, whether they're at home, whether they're in the office. But the bottom line is this. One of my friends and one of my great colleagues is a woman by the name of Mary Ann Ty in New York City. She's the #1 leasing broker. She's been named the most powerful woman in New York a few times. She said, if you're a young graduate of college or MBA school, you didn't move to New York City or to Omaha to work out of your apartment. You came there to work in an office with people that are like yourselves, with bosses, and to learn and to be mentored. So the bottom line is people will go back to the office and they will be more productive than they are there. And I learned that from a labor perspective, not from a real estate perspective. So the other mega trends that I could talk about include things such as money, the cost of money, the availability of money, and what that's going to do to impact all of you. Because I don't believe we're going to be in for inflationary pressure, because I disagree with Uncle Milty, if you remember, because I don't see a huge spike in inflation. And because of that, I think your money is going to be worth very similar a few years from now, rather than what it's worth today, where a lot of people say, oh yeah, you're going to lose all your buying power. I don't believe that. What does that mean? It means that you don't have to go rush and buy stuff today, or gold or other things, in order to protect yourself, because I think that long term, we're in for slow and steady rather than this spike type of environment. And that's how it's going to impact your day-to-day decisions. But one area that is being materially impacted in the short term from inflation, and this causes real pain, is the cost of labor. And why is the cost of labor being impacted? Well, a couple of reasons. Some of you are going to say, oh, because unemployment insurance has lasted too long. People now are not going back to work because they don't have to. Well, there's some truth to that. But also there is a labor shortage. Let's remember, the unemployment rate has been dropping like a rock since COVID began. And before COVID, it was under 4%. So labor has power because there's less of it, and because of unemployment insurance that's keeping people at home. And so what happened? True story. Just got off the phone with my wife, who owns her own physical therapy practice with another person. They're in trouble because they can't get techs to work in their office. And because of that, they may have to go out of business because the cost of their techs are going up like wildfire, but insurance reimbursements are going down. You guys can do the math. So there will be some casualties because of the labor shortage, because of the rising wages. Now, do I want people to make more money? Absolutely. But the bottom line is that people can't make more money over the long term unless they're more productive. It will put businesses out and will lead to more automation, which is another mega trend I want to talk about. Maybe I'll end with that mega trend and we'll then go to Q&A. What is automation? Automation is using technology rather than a human to do a task, okay? And that comes in the form of both machinery and my favorite word, data. Okay, I'm a data guy. I used to run research. I'm still a research guy. And I'm supposed to say, oh, data is king. If it's not data-based, I can't do it, right? Wrong. Why? Well, let me tell you a little bit about data during the COVID crisis. So data during the COVID crisis started early on, where people were surveying people about what do you want to do about the future of office. And so KPMG did a study last August of 2020. And that study showed that 80% or 70% of the CEOs they surveyed said, oh, we're going to go to a hybrid workforce. We're never going back to the office, right? Fast forward to March of 2021. KPMG surveyed the same CEOs. That 70% number went to 17%. 70, 17. What did it mean? It means that when people were under duress during the COVID crisis, they said things that they wouldn't have agreed to otherwise, which brings me to my key point. Data is an input to your decision-making. Algorithms are an input to your decision-making, but it is no substitute for a human judgment at the end of the day. Where did I learn that little nugget from? I learned that little nugget from Jeff Bezos, you know, the richest guy in the world, the guy who just went up in a rocket last week, that Jeff Bezos. Because when Jeff Bezos runs a meeting, what he does is he requires everybody prior to the meeting to read all the materials. And then in the meeting, they bring in nothing. And then they tell stories. And then Jeff Bezos, remember, the richest guy in the world, makes his final decisions with his gut, not with his head, with his judgment, not with data. So a lot of people put data on a pedestal today. I do not. I use it as an input. And in particular, in our industry, in the commercial real estate industry, we don't sell commodities. Now, single family homes, there are algorithms that get you much closer to the fair market value of a home than does our industry by light years. And many people actually buy homes that way if they're trying to get a portfolio of homes to do single family rental. But in commercial real estate, an office building that is right across the street from yours that's identical in every way ain't identical. Everything is different. And that is why data is less good. Is that even a way to say things? I don't know. Not as good in our industry as it is in others, because you can never get down to the point where data will give you a perfect answer. Data will never give you a perfect answer in any industry, but much less so in ours than in others. So I talked about several mega trends here. I talked about data. I talked about globalization. I talked about demographics. Talked about the money supply. Talked about its impact on commercial real estate. But let me sum up like this, because I want to leave 20 minutes for questions. The economy is in remarkably good shape. Remarkably good shape because of the inflow of so much money that propped us up. And that's going to be a very good thing for the next 2 years, year and a half. After that, we're going to revert to the slower growth future that we had in the past. I am an optimist, but I see nothing on the horizon that's going to make us grow faster after that, whether it be an infrastructure plan or otherwise, because these mega trends that I just mentioned, led by demographics, are going to put a weight down on our economy. As far as Omaha goes, I do see the COVID crisis as actually a net positive for your market because of remote work, because of cost of living, but you are still going to compete with those mega cities, and you should compete based upon the quality of your talent, not the cost of living there. And with that, I'd like to bring back my good friend Alex Epstein, who's going to moderate the Q&A. Alex, come on back. Or Jay, one of you guys.
Thanks,
Okay.
Spencer. Appreciate it. I was just trying to get my video started. So we got a few questions. The first one's from Mike App with Bridges Trust, our platinum sponsor. He asked, real estate is a 10-year or longer time horizon asset class. What is the single biggest risk to our real estate returns over the next decade?
Demand. So even though I am an optimist right now on people coming back to the office, and it's research-based, it's not based on the fact that I work for a big real estate company, nobody really knows what the new normal looks like in office demand. And so I look at comps around the world. So I was on the phone the other day with Brian Kingston, who's the CEO of Brookfield, the second largest owner of office properties in the world. And he said that his office assets in Seoul are 100% occupied. I was on the phone the other day with Carmen Hurrigan, who is the CEO of Charter Hall, the largest owner of office properties in Australia. Her office assets in Melbourne and Singapore are 70 to 80% occupied. Are those perfect comps for what we're going to see here? I think they are, but I'm not certain. So I think demand is going to be the biggest sap of value in the intermediate term, certainly in the office sector. I think the other thing that's going to sap value are bubblets. So even though I disagree with the large international investor I just spoke to 10 minutes prior to this call, I know a lot of investors that think there's a bubble of sorts in industrial right now, that it is priced to perfection, that people are paying nosebleed prices for mediocre assets, and that you will see cap rate expansion in that sector. So the areas that are too hot, that are too small, like data centers, like industrial, like life sciences, there's a risk that they're going to be overbought. So I think the combination of a demand fall off, particularly in the office sector, combined with there's just too much money chasing too small a space, I think that those are the two biggest risk factors right now.
Thanks. The next question we'll do is from TJ Twitt with Omni Partners. How does onshoring manufacturing, assuming some will be heavy manufacturing, and a growing concern for the environment coexist or reverse globalization?
Well, the environment, I'm glad you brought up the environment. I brought up ESG. I can go into 2 hours on the environment, okay? But I think the key word you want to look at for the environment is holistic. And when you look at things, you need to look at them holistically, not as an end game. So in the commercial real estate industry, it is, here is my physical building. That's how people have looked at these buildings historically. From an environmental standpoint, what is your wastewater usage or wastewater creation? What is your energy usage? What are other green elements of that physical structure? People are now looking at them differently. So the question of your listener, shorter supply chains are greener than longer supply chains. Trucks emit carbon. Boats emit carbon. And so part of the reshoring actually is greener than is offshoring at a cheaper location. Another thing that's greener are the use of materials that you use in your building, not just local materials, which are greener going from point A to point B, but switching to things like going from steel frame buildings to wood frame buildings. So Alex, here comes yet another shameless plug for the Weekly Take podcast. I had on my podcast the other day a large developer called Hines, and they're building a lot of cross-laminated timber buildings, meaning wood-framed office buildings. Why? Because they're seeing great tenant demand. As a matter of fact, the guy that was on my show, this guy named Steve Loftman, was saying he has tenants literally walking through the building and touching the building, right? When's the last time you touched your building except for a doorknob, right? Because they have an emotional connection to that building. And then I had somebody push me back the other day on one of these panels. Oh, killing trees is bad. Well, you know what? It's not as bad as making steel, because wood is 10 times more green than steel framing once you take the entire carbon footprint of producing steel into consideration. So you have to look at things holistically. So to the question of the person the question that was just asked, yes, you will see some reshoring to shorten those supply chains, because shorter supply chains are greener if you look at it holistically.
Thanks, Spencer. Another question from me. I know we have a lot of multifamily owners and investors on this call. And so, multifamily has been so bullish, seems, over the last decade. What's the next decade look like for multifamily and growth? I know we've talked about single family thus far, but curious about your take on multifamily.
I love multifamily. Okay, let me just start there. And I think the next 10 years is going to be very, very good for multifamily, but they are now competing with this new competitor, single family homes. Did you know, Alex, that there are more single family rental units than there are multifamily rental units in the United States? That's a significant issue in markets like Dallas, where you have a huge single family stock that competes with you. So you do have to look at that as a competitor, not just the multifamily next door. But what makes multifamily so good is, number one, there's an overall housing shortage. And that's before you even talk about affordable housing. The other thing that makes it so good is that supply challenge is going to continue in the areas that need it. And I don't want to get on my political soapbox here for a second. It has to do with NIMBYism. People don't want multifamily built in suburban locations. And so because of that, you have a supply advantage in those suburban areas where you do own a multifamily, because it's so hard to build. Now, you should also know I am the chairman or the co-chairman of the Research Committee for the Real Estate Roundtable, the largest lobbying group in the industry. And I was on the phone with my committee yesterday, and we were talking about how do we get more multifamily. And what we're looking at, a lot of people say, oh, we'll convert old office buildings. And I said, not going to happen, except in high density markets like New York City or San Francisco. What could happen is you take these dead malls, and rather than turning them into a Lowe's or a Sam's Club, you turn them into a mixed use development. So I think the future of multifamily, the most high-end multifamily, is going to be in these mixed-use developments, malls is an area there if you can get the zoning to go vertical, because these malls are often in these same suburban areas where NIMBYism keeps them out.
Thanks, Spencer. The next question from Gil Cohn is, seems like economic ups and downs seem to cool by the time they get to cities or states like Omaha, Nebraska. Do you see this as a continuing trend, or are we just lucky? So basically in the next recession, do you think cities like Omaha won't get hit as hard or otherwise?
Well, there's two ways to look at that, Alex. One is slow and steady wins the race. I just note for the record, the only city in America that did not go into recession during the global financial crisis in 2008 was Columbus, Ohio. So similar city in many ways to Omaha. But there's another way to look at it. And this comes from a movie called Parenthood from Steve Martin in the 80s. And they had the grandmother telling the story, says, I don't like the merry-go-round. I like the roller coaster. And I think the roller coaster, there's advantages to it, because the only cities in America where you're seeing true rent growth in office are the cities that are the roller coasters. Yes, it is extraordinarily volatile rent in New York and San Francisco and Boston, in Austin, Texas, but they are going down and coming up again. They're going down and coming up again. So I think that slow and steady winning the race is a strategy. It's good, it's stable, but it is not a long-term winning strategy. The only way to win in the long term is to have the highest value add market, the best talent, the most sophisticated manufacturing, the most sophisticated products. Slow and steady is a recipe for getting passed by other markets. So no, I respectfully disagree with that. I do not think that's an advantage of Omaha. I think that it's a disadvantage if that's how people look at it.
Makes sense. Thanks, Spencer. The next question is a question of mine. So it seems like it's been so long since we've seen interest rates steadily go up. Will we see that environment in the next 10 years? And if so, how do you see that affecting our economy?
Well, I just went on the record once again on this very call. By the way, that's my dog Murphy. I just went on the record once again on this call by saying I don't think inflation is going to be lower for longer. I think it's going to be lower forever. And so because of that, I do not see a rising interest rate environment. And I'm sure whoever asked that question, whether it was you or somebody else, Alex, is a Milton Friedman fan saying, oh, this money supply, we're going to push up inflation and push up interest rates. I don't believe it's going to happen. If that does happen, if I'm wrong, yes, then you're going to see an increase in cap rates. And then you're going to see a diminution in the value of real estate assets. Now, the bottom line is this, so I just don't see that happening over the next decade or beyond. Now, let me say something else. I hope it does happen. Why? Because if interest rates are going up, it means we're growing faster than I thought. And I want to grow faster than I'm predicting on this call here today, because in the absence of more rapid growth, you become a stagnant economy. And I'm not going to like point fingers at Europe or Japan and say your stagnant economies, you're bad, because there's a whole other way of looking at this. I did a debate a couple of years ago with a guy named Dave Bratt, who was a congressman from Virginia. And he said, you know, we're looking at this world the wrong way. We should not be looking at this world through the prism of growth at all costs. We should be looking at this world through the prism of standard of living, which is a different metric. And if you take a look at the world through that metric, you take Japan, which hasn't really grown much in 30 years, they have among the highest standard of living in the world. There's something known as the misery index. They are the third least miserable country on earth because their people live the longest. They have great health care. They have great infrastructure there. And maybe that's a better way to go. I personally don't agree with that. I personally believe that growth is the way to go, but there's an increasing chorus of people that believe that slow and steady and standard of living is a better way to look at the economy.
Thanks, Spencer. So with you saying that, you know, you don't expect growth, you know, as fast as we've experienced it, what asset class do you know, are you most bullish on over the next, 10 years?
Real estate or otherwise?
I guess if you could talk real estate, and then also if it's, the public equity markets, how do you see this economy affecting the publicly traded markets of growth stocks versus value stocks versus, anything you can invest your money in today?
Sure. So I have my money under my mattress upstairs and waiting for, no, I'm not doing that. Right. The only thing that's ever made me money in the stock market is just keeping it in there long enough. Right. How do you think Warren Buffett made most of his money? He's brilliant, but he's also like 90 years old and he's had his money in the market forever and been a great investor. Time has been his friend. Right. That's a good example of the stock market. So I'm not going to give you any stock tips other than just hang on and through the ups and the downs. But on the real property markets, I will say that if you look at the mega trends, there's a lot of people looking at these so-called new economy asset types, which is life sciences, which is industrial because of e-commerce, which is data centers. All of the mega trends point in that direction. But you're also risking oversupply. You're risking people overpaying, which is that cap rate bubble I mentioned before. So I'm going to say this not to be a self-serving guy, or to emphasize something I said before. I think multifamily is the safest long-term bet of the asset classes. But I think that office is oversold. I think that right now, if you want value, find good office with decent WALT, weighted average lease terms, in growing demographic areas. You're going to get the best value there by far. And I think you're going to get paid for that in the next couple of years. So the problem with multifamily is you're paying a 4 to 5 cap right now. In Omaha, maybe you're paying something between a 5 and 5.5. But the point is that very hard to get value immediately in multifamily today. But I think it's going to be the most stable asset class over the next decade.
Thanks, Spencer. Another question from David Schwab. What role do you see for rail in the industrial real estate sector going forward?
Well, another Warren Buffett special, since didn't he just buy like the Santa Fe Railroad a couple of years ago? I think rail is great for logistics. I think it is poor for people moving. Now, I live in the Northeast, okay, and I'm a train guy. I grew up taking the commuter rail. I take the Amtrak once a week between New York and Washington, D.C. Okay, it's fantastic, but the density of people here makes it fantastic. I've taken the Amtrak between Chicago and Milwaukee. I was the only guy on the train. I took the Amtrak between San Diego and LA. Nice train right along the coast, only guy on the train. So I think for intermodal from an industrial standpoint, extremely important because it's very efficient. And if the trains have the right form of energy, very, very clean. But as it relates to high-speed rail to move people, that is not the way to go. What we're ultimately going to enter into is a place that has cleaner cars, not rail that are going to take people from point A to point B. I think that's our future. In fact, not to advertise, but CBRE just entered into a relationship with a company that has solar panels, right? I had them on my podcast yesterday. And what they're talking about is vehicles in the immediate future, next couple of years, being not only vehicles, but vehicles with batteries that are twice the size of the batteries today. So they not only can get charged up using solar power at your buildings, they can take that power home and fuel your house. So vehicles serve multiple purposes, not just transportation. They also serve the green purpose of having clean energy going from point A to point B. Trains can't do that for people, but I love trains as it relates to intermodal travel for logistics.
Thanks, Spencer. Let's see here. Question from Doug Seaman. Is there something like a population threshold for agglomeration, for the agglomeration effect? Meaning, is it a minimum of 1 million people or something along those lines?
Well, look, you can have mini agglomeration effect, and thank you for using my fancy word here today, whoever put that in there. What you really need to look for are submarkets that have some form of the agglomeration effect. And so you go to a city like Chicago, and Chicago has the Loop, but they also have an area called the Fulton Market, which is actually not on the rail line. It's actually not that convenient to get there. But you know who just moved there? McDonald's just moved their headquarters down there. Google just moved down there. And they have every hip, cool, young restaurant, multifamily deal. They have a mini agglomeration effect in that submarket. So to the caller's question, what you need to look at are submarkets within smaller markets that have those characteristics. And very often, and I say this somewhat tragically, it's not in your CBD. And so I go to a lot of markets. When I say a lot, You're talking to the guy who travels 200,000 miles a year pre-COVID. And I see a lot of these older CBD areas with a lot of buildings that were built in the 70s and 80s. That's not where you're going to see the growth. Where you're going to see the growth are in these areas like the Fulton Market, like the Third Ward in Milwaukee, like the Wynwood section of Miami, where they have the Basel Art Festival, like the LA Arts District. Look, folks, I do this for a living. And I'm telling you, in these submarkets, you have the agglomeration effect, even if it's not with the same size of population.
Thanks, Spencer. Well, I just can't say enough about how insightful this was. The Omaha community is so blessed to have you with us here today. It's been a kind of a once a year treat these last couple of years. Hopefully we can make it even more and do something in person in the future. But we're, from the Jewish Federation of Omaha, the Jewish community, Jewish business leaders, myself, thank you so much for your time. I think we all learned a lot on a lot of complicated subjects that you make easy to listen to and easy to understand. So thanks so much.
Speaking of easy listening, my last plug, please listen to the Weekly Take podcast that I host. You're going to love it. Easy listening.
Perfect. And I'll let Jay Cattleman close it off for us.
So thank you so much, Spencer. It was a wonderful listen. It was very informative, and I know everybody got a lot out of it. So from the Jewish Federation of Omaha and the Jewish business leaders, we'd just like to thank you again. And I would also like to thank our wonderful sponsors, our Bridges Trust, our platinum sponsor, Lindsay and Alex Epstein, and CBRE for sponsoring this event. And I look forward to having everybody in person on August 13th for our next event. So thank you, everybody. I hope you learned a lot, and we will see you in August.